Hello all and welcome again in this series of lectures of financial accounting and analysis. I, Dr. Shikha Jalota, welcome you for this session. So in the previous sessions, as you remember, we talked about the final accounts, that how to start with preparing the final accounts. So we talked about the trading account, as that is the first account we should prepare for preparing the final summary. So trading account we have studied, and now you know very well that the resulting figure of trading account is the gross profit or the gross loss. So moving ahead with the next format that we need to prepare for the final accounts is P&L account. So let's take up the P&L account now. So what is P&L account? P&L account is basically the second statement of profit or loss, or you can say the revenues on the expenses that the business earns. So this is, as we have discussed under the trading account, that under trading account we take the, on the credit side, we take sales, and that is one of the major revenues of the business. And on the debit side of trading account, we take all the direct expenses related to the production of goods, like factory related expenses, the purchases, stock, whatever. So the result of the trading account gives you the gross profit. We call it, as we have discussed in the previous lecture also, that gross profit is nothing else but reducing down the sales revenue with the direct expenses. The balancing figure is the gross profit or the gross loss. Now, when we proceed further with the P&L account, so P&L account is basically the account or the statement where we consider all the indirect expenses and indirect revenues. Like, for example, all the expenses or the revenues which have not been generated from the sale and sale purchase, but it has been generated uh, with the running of the business. Like when it can be the advertisement expense is a good example of indirect expense. See, when we do the advertisement expense, we do not know that how much expense is being done and how much benefit we get out of the advertisement expense. So it is simply that all the indirect expenses are considered under the P&L account, and direct expenses are all considered under the trading account. So whatever result we get out of this profit and loss account, this is the final profit that any business can assume to be its profit or loss. So as you can see here in the first board, it is saying to know the profit or losses incurred or earned by a business in a particular accounting year, we prepare the profit and loss account. And of course, it is a statutory requirement also, because under the Companies Act, or if it is a partnership business, then Partnership Act, you need to prepare this profit and loss account, both for the ITR purpose also, and for disclosing such documents in the general public also for their own use. So profit and loss is mandatory for each and every business to prepare such accounts. Taking further, net profit, as you all know that we have discussed right now also, that net profit is the result of the profit and loss account. As we have discussed in the trading account, gross profit or the gross loss was the result of trading account. The balancing figure of trading account is the gross profit or the gross loss. In the same way, after putting all the indirect expenses and indirect revenues in the P&L account, the resulting figure, the balancing figure that we get out of that account is the net profit. So you can simply say that net profit is the difference between the total revenue of a certain period and the total expenses of the same period. So why we are using it total revenue here? Because total revenue here means we are considering under revenue all the direct and indirect revenues. Like the direct revenue, we have taken sales in trading account, and indirect revenue like interest received, commission received, discount received, whatever. These all things are the indirect expenses for the business. So indirect revenues for the business, sorry. So indirect revenues and indirect expenses all when have been considered from trading and trading till P&L account, and the difference now whatever we'll get out of credit minus debit is the net profit or the net loss. So net profit is made when the total revenues exceed the total expenses. Of course, when revenues are higher than the expenses, it is a net profit situation, and reverse is the net loss situation. So the balance of P&L account, which is represent either net profit or net loss, is transferred to the capital account. So how to treat with this point, this we'll see at the later stage of the today's session. So let's take up the net profit and P&L account format here. Have a look at the P&L account format. You must be finding difference between the trading account format, a little bit of difference in trading account and P&L account. So this is the format of P&L account. As you can see here, at the top, it is the name of the company. Profit and loss account heading is written. You can also write profit and loss account of dash dash dash, like a particular company's name. And again, as you have seen in the trading account, in the P&L account also, you have to write for the year ended 31st March or 31st December, whatever is the date. So for the year ended here means the same as it was in the trading account, that whatever information is being mentioned here in the P&L account is for the whole year starting from 1st April till the date this account is being prepared. So the very first thing for the P&L account that needs to be done is you have to transfer the gross profit or the gross loss that has been that you have got under your trading account. So trading account, whatever is the information of gross profit or gross loss you have got from the trading account, whatever is the balancing figure, that you have to first transfer to the P&L account, and then you will move further for making the other entries. So as you can see here, the first item on the P&L account is the gross profit or the gross loss. If the gross profit is there, you have to brought it down on the credit side. If gross loss is there, put it on the debit side, first item. And then after transferring this gross profit or the gross loss from the trading account, then we'll proceed further for the next other expenses, like any other expense given in the question, you have to put it under the P&L account, like office related expenses, rent, salary, telephone charges, printing, stationery, carriage charges, freight outward charges. See, if freight inward is there, as I told you, for the carriage inward, carriage outward, in the same way, freight inward, freight outward is there, then accordingly you have to treat it. Freight inward will always go to the trading account, freight outward will appear in the P&L account. Then advertisement, discount, bad debts, any debt which has been converted into bad debts, that you have to mention here. Then one of the important item under this is depreciation. Any sort of fixed asset, if there with the firm, then you have to charge depreciation on it. So depreciation charges you need to calculate and put it under the debit side. Then all the credit side items, that is the revenues that the business has received, revenues or any gain in the business, that will be recorded on the credit side, like any interest received, commission received, discount received, in like interest on drawings, etc. There are n number of items you have to decide looking at the like in a question, that what all items are there for the P&L account. And after putting in all the revenues and all the expenses, then you can finally calculate the net profit or the net loss for this question, for this particular account. And in the same way, you have to add up the credit side total and the debit side total, and whatever is the balancing figure, that will be your net profit or the net loss. So whatever is the difference, like in the case credit side is higher than the debit side, then of course it will be a situation of profit. So net profit will be written on the debit side. And then if debit side is higher and credit side is lower, then in that case it is a situation of net loss, and you will have to write the net loss. So which will be further transferred to the capital account. What will be the treatment under capital account for this, that we will discuss when we'll prepare the balance sheet or discuss the balance sheets. So moving on further to the balance sheet here. as you can see, the trading account or the P&L account, this is the format of accounts where at the end on the credit side, you write all the revenues, all the incomes, all the gains, and on the debit side in both the accounts, you write the expenses. But and at the end, what you'll do, you balance the account. Like when you balance the trading account, you get the gross profit or the gross loss, or when you balance the P&L account, you get the gross profit or net profit or the net loss. But balance sheet is a different format. Balance sheet is a statement. You don't need to balance it. You need to simply prepare a set of, you can say, the list of assets and liabilities in a systematic manner, in a sequential manner. So balance sheet is a statement which states the assets and liabilities of a firm at a certain date. So when balance sheet is being prepared, it is prepared for a certain date. As even a single transaction can make a difference in assets or liabilities, so the balance sheet is true only at a particular period of time. So when you prepare a balance sheet, one balance sheet prepared for a particular date will not solve the purpose for any other date, because even a single small amount of transaction will reflect its changes in the balance sheet also. So balance sheet will, for each and every date, if you require the balance sheet, that is not possible. You have to compare the balance sheet. You have to prepare the balance sheet at the end of the year. Or if you want the balance sheet to be prepared in between, then also you have to prepare the balance sheet for the particular date you want that balance sheet to be there. You cannot take up the balance sheet of the previous year or the previous time period. So as you can see here, this is the significance of asset in the balance sheet. It is based on the accounting equation. And you can say, yeah, very true. Accounting equation is the basic concept of balance sheet, which says that total assets is equal to total liabilities plus capital. Now, as you know very well that balance sheet is a statement and it is not an account. So you do not record the transaction as per the debit side or the credit side. But yes, you can very well say that assets have the debit balances and liabilities has the credit balances. So assets appear on the right side of the balance sheet. If you compare, it is a bit different. Assets being the debit balances and appear on the right side, and liabilities having the credit balances appear on the left side of the balance sheet. So if we see the description about the assets here, so assets for the purpose of putting up in the balance sheet and otherwise also, the assets have been divided into three major bifurcations. One is the long-term assets. Long-term assets are basically the ones which is there with the firm for the very long period of time. That is, for example, you can see here land, building, plant, machinery, vehicles, equipment. These all are the assets which are going to be there with the business for a longer time period, maybe more than 1 year. Then current assets are the ones which are the assets which do not have the life of more than 1 year, or you can say that these assets are the ones which can be easily converted into cash from the market as and when required by the business. Like cash in hand, this is the most liquid asset you can find in the balance sheet. Then cash at bank, receivables, inventory, stock, debtors, these all are the you can say short-term assets which can be easily converted into cash or liquidity whenever required by the business. Then comes the intangible assets. Intangible assets are the assets which cannot be seen or touched, like for example goodwill, patents, copyright, etc. These all are the assets which are inferred on the business, but you cannot see it, you cannot touch it, you cannot feel it. But these all are the assets which can be mentioned in the balance sheet, because these are the things which can be measured in terms of money. So identifying the value of these assets in terms of money will make it possible to put it under the balance sheet assets side. So this is for the assets Then we'll come to the liability side. Liabilities are also having two major bifurcation, because liability we cannot find in an intangible form. So for liabilities, it can be long-term liabilities or the short-term liabilities, or call it as the current liabilities. So long-term liabilities are obviously the ones which is there with the business for more than 1 year of time, longer period of time, like long-term loans from the bank, etc. And then current liabilities are the ones which the business need to settle within less than a year, like trade credits, creditors, outstanding expenses, etc., bills payable, etc. So why we are discussing this? Because they have a great importance to understand that whether the asset is a current asset or a fixed asset, or long-term asset or a short-term asset, and accordingly we have to place the assets or the liabilities in the balance sheet. So let us take the balance sheet first. This is the format of the balance sheet. As you can see in the heading, it is written balance sheet of, where you have to write the name of the company. And it is must that you write after that as on the particular date. As if you remember, under trading account or P&L account, we were writing for the year ended. Like for the year ended means ki whatever the information is there in the trading account, it is for the whole year. But balance sheet is a quite different thing, where you mention all the information which is there on a particular date. Like if you are preparing the balance sheet on 31st March 2020, that means that whatever information is being mentioned under the balance sheet, under assets and the liability side, it is applicable only for 31st March 2020. If you consider 1st April 2020, then also that balance sheet will not be considered as like authentic. So whenever you prepare the balance sheet, you have to mention the date, like as on whatever date you want to prepare for the balance sheet. Now coming to the two bifurcations, as you can see here, it is divided vertically into two parts, the left hand side and the right hand side. Left side is the liability side, right side is the assets side. And you can see then later at below, there are number of assets mentioned, number of liabilities mentioned in their respective sides. So while placing the assets and the liabilities, there is the concept which needs to be kept in mind, that whenever you write any of the asset or the liability in the balance sheet, they should be in a particular order. Order in the sense, there are two orders to keep the balance sheet records. One is the liquidity and other is the permanency. Like the format that you see here is as per the liquidity, means the most liquid asset at the top and the most you can say permanent address asset, most illiquid asset at the bottom. So the most liquid asset for any of the business is cash in hand. That is the liquid asset you have. Then comes the cash at bank. So when we talk about the liquidity pattern, so we put up the assets as per their liquidity, like how easily any of the asset can be converted into liquid. That should be the order. Like when we talk about plant and machinery or land and building, business premises, patents, as you can see here, goodwill, these all are the assets which take time for the business to liquidate, to be converted into cash. It is first the debtors or the investments or the closing stock. These will be first converted into cash if the business requires, or can be easily converted into cash if the business requires it. So this is the order given as per the liquidity. Now suppose if we talk about the permanency order. Permanency order means at the top you have to write the most permanent asset which will go off from the business at the end. So if you are preparing the order as per the permanency, in that case, this order will, this sequence will become vice versa, exactly opposite. Then in that case, goodwill will be at the top then comes the patent, then land and building, then plant and machinery, and then at the end you will keep on mentioning the current assets like closing stock, investments, sundry debtors, bills receivable, and then at the end it will be cash at bank or cash in hand. So when you are preparing the sequence as per the liquidity, you have to put in the most liquid asset first and then followed by the less liquid assets. And if you are preparing it as per the permanency order, then you have to write the most permanent asset at the top and then keep on following with the less permanent asset. So if we follow the liquidity pattern, then of course cash in hand will be the first item, and goodwill or land and building, depending upon the assets that the business have, will be the last item. If we follow the permanency pattern, then goodwill, plant and building, you can say machinery, land and building, these items will be at the top, and cash in hand, cash at bank, etc. will be at the end. And one more thing you have to keep in mind, that whatever pattern you are following in order to write the assets, the order of assets, sequence of assets, same pattern you have to follow for the liabilities also. Like for liability also, you have to define the pattern, like and whatever pattern you're following for assets, like if you're following liquidity pattern for writing the assets in the balance sheet, you have to follow the same liquidity pattern for the liabilities also. Or if you're following the permanency pattern, then in that case, liabilities should also be in the permanency order. So if we talk about seeing the liability side, sundry creditors, bills payable, overdraft, outstanding expenses, these all are the short-term assets. So if you are writing the liquidity pattern, then these short-term assets will come at the top and then will be followed by the permanent, you can say long-term liabilities and the capital. So one more important thing here for the balance sheet is, and further we'll discuss as on when we'll take up the numerical questions and if the complications arises. One more thing which I need to discuss here for the liability side is the capital. Like there are certain adjustments that you need to do when you write capital in the balance sheet. Like the capital account that needs to be adjusted with the net profit or net loss. Net profit will be added to the capital, and net loss, if there is, reduced from the capital. Then further is the drawings. If there is any drawings in the like a question, it has been mentioned that there are certain drawings, then that drawings need to be reduced from the capital amount. And if income tax is being paid by the owner, then obviously that income tax will also be reduced, and the final amount of capital after considering all the adjustments here will be further taken to the final column of the balance sheet. Then balance sheet liability side, and then when you have put in all the assets and the liabilities on its place, then you can finally add up the total of the assets and liabilities amount column, and ideally the balance sheet should match. Then only you can say that you are preparing the accounts in a fine manner, because since you all know very well that accounting equation says that assets should be equal to liabilities plus capital. So right side is the asset side, and on the left side it is liabilities plus capital. So these two totals should be equal to each other, then only your balance sheet has been prepared properly, or there might be some error at the back stage or at the back steps. So this is it for the today's session. We will meet up again with some new questions depending upon the final accounts, and we'll try to prepare final accounts, P&L account, trading account, and balance sheet. So thank you for now. Thank you. We'll meet up again in the next session. Thank you.